Hello, welcome back to Life Enrichment with Hank Ballinger. Today I want to go over a topic that probably a lot of people would look at and say, those are not very fun topics. And they may be right. But nonetheless, if we're going to get into building wealth, these are some things you're going to have to deal with. Doesn't really matter what kind of business you get into, you're going to have to deal with them. You're going to probably be borrowing money from the bank to get into business. You're probably going to be buying food. So you're going to have to worry about interest rates and you're going to have to worry about inflation. Notice the price of eggs lately. Inflation happens. So as we look at inflation versus interest rates, we need to realize that sometimes these things can work together for our benefit. And a lot of different things that you do in business, if you can make business very personable to who you are, make whatever business you're into part of who you are, you can start realizing many aspects of society, banking system, the monetary system. You can make those things work for you the more you know about them. But if you don't know anything about them, it's hard to make them work for you. So a little bit in business, you need to understand inflation and you need to understand interest rates and how sometimes they can work really for our benefit. Let's look at this. First of all, how to make sense of interest rates and inflation. Now, on the surface, we'd say, it's just some of that macroeconomic stuff, no fun. But I think if you see how you can use it for your benefit, then it starts becoming more fun rather than just some of those aggravating things you got to try to keep up with. So let's look at these graphs. Inflation generally is how much products go up, the things we buy, the goods and services that we use every single day. And again, you go to the grocery store in the last year, you notice that groceries have been going up. That's inflation, it goes up. Now, some might argue, well, if our pay goes up equal to the amount that the groceries go up, that's not inflationary. And they would be right. But nonetheless, groceries have gone up. But today we're not going to get into the debate. We're going to look at how we can use interest rates versus inflation. Now, interest rates. Let's say you go to the bank and you want to borrow some money and you say, I want to borrow $100,000. Now, your interest rate that you're going to pay the bank, let's say, is at 10%. But inflation in society, things are going up at 5%. Now, the average homeowner would probably look at this and say, well, this is not bad, especially if they got their house paid off. They would say, well, I don't have a house payment, so I don't have anything to pay the bank there, and inflation is pretty low. But I would argue, if you're into business, specifically real estate, you don't want this, you want this. And we'll get to that in just a minute. Now, if interest rate is at 10%, okay, and inflation is 5%. Now, if you go to the bank and get a loan at 10%, that means if you borrow $100,000, in that first year, you're going to be paying them back $10,000. But if the value of your property, if inflation is at 5%, your property that you bought for $100,000 then goes up to the value of $105,000. You see, the inflation is 5%, so your property goes up 5% in value, but you have now paid $110,000. So if inflation or interest rates is higher than inflation, you're kind of losing a little bit of value there. Now, you gain other value and equity and some other things, so you're still going to win with these numbers. I'll show you that down here. But just the metrics of you borrowing the money and the value of your property going up, you're losing 5%. Okay? Let me show you another way that really works well. Let's say inflation is at 10%. Now you obviously don't want that on your food and on the things you buy, gas, stuff like that. But let's just say you paid $100,000, remember, on a piece of property. If inflation is going up at 10%, that means at the end of the year, that property that you paid $100,000 for a year ago is now worth $110,000. But if your interest rate at the bank is 5%, at the end of the year, you've only paid, you took out a $100,000 loan, and let's say that's the total amount you took from the bank, and then you owe them 5%. At the end of the year, you will have paid them $5,000. Your property went up from $100,000 to $110,000, but you have taken out $100,000 and you've paid back $105,000. You've gained $5,000 in equity on that property just by the value of the property going up more than your interest rate. That's a pretty good deal. So if you have real estate, this metric works really well for you. Okay, so I want to show you something that happened. Now, if you're very young, you won't remember back to 1980. Okay, that will be a long time back for many people. Myself, I was born in 1963, so 1980s was a good time for me. I was in high school and times were good. But for everybody, times weren't good in the early 80s. Let me show you what I mean by that. During the 1970s, two things happened that made interest rates go really high in the late 70s and early 80s. Two things. Number one, in August the 15th of 1971, Richard Nixon took our money off the gold standard. Now that may not mean a lot to a lot of people, but what that meant was that they could now print money at will. And it didn't have to be tied to gold and didn't have to be kept at just a certain amount of dollars because we only had a set amount of gold. And if you only have a set amount of gold, no matter what that set amount is, you can only print so much money. But once he severed it from the gold standard, then they could print as much as they want. Well, every time you print more money, it devalues the amount of dollars you do have. They go down in value. So they started printing more and more money. Well, that's kind of inflationary. But then the second thing that happened in the 70s is the baby boomers hit the workforce really, really hard. Not only the men, but the women in the baby boomers. So now you got the men wanting jobs, and a whole lot of them, and then you got the women wanting jobs, and now not only are they wanting a house, many of them are saying, I want 1 or 2 or 3 houses, and can't just have 1 car per household. We got to have 2, 3 cars. Now we want a boat, we want jet skis, and we want all the stuff that nobody else had. And you know what else we want? We want that avocado green stove and that harvest gold stove and that shag carpet. We got to have that stuff. We want it all. So they got it all and they paid for it. Let me show you what happened in the 80s. Nowadays, we look at interest rates and inflation and we say, well, interest rates are now up to about 7%, but they were down. Some people got home loans for 2-point-something%. Some at 3 point. We got several business loans in the 3s. In the early 80s, because of the severing our money from the gold standard, the baby boomers want more. Very inflationary. The interest rate in 1980, the Fed fund rate got up to 20%, which made interest rates in some banks 23%. Now, how would you like to buy a house today and your interest rate be 23%? That's pretty stiff, isn't it? In 1980, the interest rate in some places 23%. Inflation was at 14%. And Ronald Reagan and a fellow that was the chairman of the Fed, his name was Paul Volcker, they got the interest rates up, and they finally got inflation to start coming down in the mid-80s and then got it down to around 6 to 8% by the mid to late 80s. This is hard to make any money. Let's say you bought a $100,000 property and you're paying, by the end of the first year, you have paid $100,000 plus $23,000 in interest in the first year. But that thing's only gone up in value by $14,000. So you're kind of losing here with this metric. Now that was back in the 80s, the early 80s. Do you realize that the interest rate kept coming down, and kept coming down from 1980 to 2022? The interest rate came down, down, down. Now let's look at something. Today, if you look at the federal government's website, they would say the interest rate's about 6.5 to 6.8. Now, let me give you a site that's probably a little more accurate. It's called Shadow Stats. Now, if you will look up Shadow Stats, they will tell you that today the interest rate, the true interest rate, if you really look at all the food, all the energy, all the housing, all of those things combined, the interest rate is 17.3. Now, how does our federal government say that, inflation? How does our federal government say inflation is 6.5 to 6.8, but Shadow Stats says it's 17.5? Well, actually the government a lot of times takes housing and energy out of the mix, or sometimes food, which are some of the bigger metrics that make that rate higher. Also, on many products, they do what's called hedonic adjustment, meaning if a car costs $15,000 this year and it costs $20,000 next year, our government may look at it and say, yeah, but there's enough extra stuff on that car that it's the same car, but they put maybe a backup camera and they put heated seats and they put enough stuff on it that really that car is a better value. So even though it's $5,000 more, our government looks at it and say, well, it's still cheaper. It's a better car, so it's cheaper. And that number would even lower inflation. I'd rather look at somebody like Shadow Stats. It's a little more honest, in my opinion, and puts a lot more of the stuff in there and don't get into hedonic adjustment. So anyway, if you bought a $100,000 property and inflation is at 17.3%, in a year's time, that property is going to go from $100,000 to $117,300 in value. But because the interest rate now is at 7%, you will have only paid $7,000 on that $100,000 in interest. You will have gained 10% in just inflation going up. So if you have property, if you have a lot of real estate, you want this metric. You want inflation going up here and interest rates down here, because it helps the value of your property. Now, just think about this. Interest rates or inflation was a little lower a little while back, but these were much lower. You remember I told you just a while ago that some people had home loans at 2.5%. We had some commercial loans at 3.75. Let's just say 4% for a good round number. So if this is 4 and this was 14, you're still at a 10% spread. It pays you to borrow money from the bank, even on the first year, just on this metric alone. But wait, that is not the only income you have on real estate. If inflation is higher than the interest rate, like this, if inflation is higher than the interest rate, you want to borrow money. That is a good time to borrow money. Now remember, I do not give financial advice. What I give is financial information. What you do with it is totally up to you. I'm not liable. If you lose your shirt, if you go broke, it's kind of on you. But if you make $1 billion, Not one penny of that's mine. That's yours. So I give financial information, but if the inflation is higher than the interest rate, that's a good time to borrow. But also, you don't just make money on the spread between the interest rate and the inflation. If you buy real estate, your property value is going up faster than the amount that you're paying the bank here. But also, every month you're getting cash flow from that property. You're also getting appreciation as you raise the rents. That property value is going up. Every April when you file your taxes, you're depreciating that property. Now, I know that sounds a little crazy. If you're a novice, you're not into real estate, you look and you say, now, that sounds crazy. How can you say a property is going up in value and then depreciate it out as if it's going down in value? The government allows that. They encourage that, actually. You can raise rents and raise the value of that property, but every April, write property off and all the depreciations that you have. And so in one way you look at it, it looks like the property's going up in value. Another way you look at it, it looks like it's going down in value. And it's legal. So you get all that equity, all that money is in. Now, a lot of this is money that you get right now. These are called phantom income. You can't put it right down in your pocket, but nonetheless, it's your money. It's just a little harder to get to. Appreciation, depreciation, and the equity you have in the property by paying the debt service to the bank every month. Part of that payment is principal. And you're, in essence, taking money out of your pocket, paying the bank, and then part of that money is going back into your pocket later. So when you look at interest rates and inflation, I know it seems like a tough topic and not really a lot of fun to a lot of people, but the more you get into it, the more you understand it, the more you can use it if you want to build wealth and become redneck rich. Thank you.